It's April 14th. You did everything right, you worked hard, you hustled, you made an extra $18,000 delivering food and driving strangers around last year. Then you open TurboTax and it says you owe $2,900. You don't have $2,900. You never set any of it aside because nobody told you that you were supposed to. This is the gig economy tax trap, and it's catching millions of drivers, delivery workers, and freelancers every single year. Here's what the gig platforms don't explain when you sign up. When you work a regular job, your employer withholds income tax and also pays half of your Social Security and Medicare taxes. That's 7.65% of your paycheck that you never see and never miss. When you're a $1,099 contractor for DoorDash or Uber, you pay all of it yourself. The full 15.3% self-employment tax, plus your regular income tax rate on top of that. On $18,000 in gig income, that can easily add up to $3,500 or more owed at tax time. The IRS expects you to pay as you earn, not in one lump sum in April. If you expect to owe more than $1,000 in taxes for the year, you're required to make quarterly estimated payments. The deadlines are April 15th, June 15th, September 15th, and January 15th. Miss them, and you get hit with an underpayment penalty on top of the tax bill you already couldn't afford. Nobody at Uber onboarding mentions this. Your activation email from DoorDash doesn't include a tax primer. You're just supposed to know. The simplest rule that will save you from the April shock: set aside 25 to 30% of every gig payment the moment it hits your account, not after you spend it, immediately. Open a separate savings account just for this money. Label it IRS account so you're never tempted to touch it. If your effective tax rate ends up being 22%, you'll have money left over. If it's higher, you're covered. This single habit eliminates the entire problem for most gig workers. Now let's talk about what you can actually deduct, because this is where gig workers leave serious money on the table. The IRS standard mileage rate for 2024 is 67 cents per mile driven for business. If you drove 15,000 miles for deliveries, that's a $10,050 deduction, which directly reduces your taxable income. You can also deduct phone expenses if you use your phone for work, a portion of your data plan, car washes for your delivery vehicle, and insulated bags or equipment you bought for the job. Track everything. Your health insurance premiums are also deductible if you're self-employed and not eligible for coverage through a spouse's employer plan. And here's one almost nobody uses: a SEP IRA or solo 401k. As a self-employed person, you can contribute up to 25% of your net self-employment income to a SEP IRA, reducing your taxable income dollar for dollar. Someone earning $25,000 in gig income could contribute over $4,000 to a SEP IRA and cut their tax bill by roughly $800 to $1,200, while also building retirement savings. Use a mileage tracking app, MileIQ, Stride, or Everlance. Turn it on every time you start a shift and turn it off when you stop. The IRS requires contemporaneous records, which just means you tracked it as it happened, not from memory in March. A $10 monthly subscription to a tracking app can be worth thousands in legitimate deductions. Paper logs work too, but most people never keep them. Remove friction from good habits. Once your gig income crosses about $400, you need to file a Schedule C with your taxes. That's the form where you report self-employment income and deductions. If math makes you sweat, software like TurboTax Self-Employed or H&R Block Premium walks you through it. If your gig income is a significant chunk of your earnings, a 1-hour session with a CPI who specializes in self-employment taxes can pay for itself 20 times over. The average CPA charges $150 to $300 for a basic return and can find deductions that save you far more than that. The gig economy isn't inherently a bad deal, but it's structured so that all the administrative burden falls on you. The platforms extract value from your labor, and the tax system expects you to act like a business owner, even if you feel like an employee. That means treating your income like a business: separate accounts, expense tracking, quarterly payments, and planned deductions. Workers who do this consistently end up paying thousands less per year than those who don't with identical income. Here's the short version. Set aside 25 to 30%, track every mile, make quarterly payments, and use the deductions you're entitled to. Do those 4 things, and you never have an April disaster again. If you're relying on gig work as your main income and you're not sure it's actually worth it financially, my video on the gig economy exit strategy breaks down the real numbers and what to build toward instead. Check it out next.